found support on the back of a weaker dollar. The greenback slipped to 7-month lows earlier this week, pressured by increasing speculation from the markets who see the Fed being forced to cut rates in 2023 in order to avoid tipping the economy into recession. Nevertheless, the next big test for equities will be the CPI print expected in tomorrow's session, and it will be a defining factor for the future direction of US stock markets. In this report, we aim to present the recent fundamental and economic news releases that impacted the US stock markets, look ahead at the upcoming events that could affect their performance, and conclude with a technical analysis. Apple, the information technology giant, famous for its iPhone series, iPad and iMac devices, was in the greens yesterday, closing the day near the $130 mark. So far this year, Apple's share price managed to rise by more than 4.5%. However, on a year-on-year basis, it shed more than minus 24% of its value, reflecting the overall pain the US tech sector has faced in 2022. Last week, a news report from Bloomberg pointed out that the company reportedly plans to swap out Broadcom chips from its devices by 2025 and instead seeks to create its own in-house components in an attempt to reduce its heavy reliance from its suppliers, cut costs, and possibly shelter itself from unforeseen supply chain disruptions. Furthermore, the company is said to be already working on a follow-up version that would combine cellular modem, Wi-Fi and Bluetooth capabilities into a single component, essentially moving away from the Qualcomm's modem supply also, yet the transition may take years. Last week, analysts also added into the mix the decision from Apple to cut MacBook and Apple Watch production levels for the first quarter of the year, citing diminished demand levels for those products. Overall, MacBook and Apple Watch account for roughly 1/3 of the company's sales, and analysts see Apple allocating more weight on its flagship iPhone production lines to fill in the gap. That being said, the push for internally designing and manufacturing their own components and gradually moving away from overdependence from suppliers could be perceived as positive news. Yet, on the other hand, the possible lack of experience in the production of such components may prove to be a considerable risk that the company is currently taking. Tomorrow, the equity traders will be sitting at the edge of their seats, awaiting patiently for the release of the December CPI print, which is expected to showcase the trend progression of the inflation burden across the US. According to estimates, the December's year-on-year CPI rate is expected to decelerate to 6.5% from the last month's 7.1%. Furthermore, the year-on-year core CPI rate, which excludes volatile food and energy prices, also for the same month, is set to ease to 5.7% from the 6% recorded in the previous month. Should the actual rates meet the expectations, that would imply that inflationary pressures are abiding and may intensify speculation that the Fed would consider slowing down its monetary policy tightening efforts. Thus, as a result, we may see the dollar plunge lower, and in retrospect, we may see the US stock markets receive support and move higher. Yesterday, Fed Chair Powell at the Riksbank Symposium in Stockholm did not provide further clarification as to how the central bank may proceed with its monetary policy path. Yet he stated that restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy. Echoing the same message, several other FOMC policymakers have been broadcasting over the past week. Thank you for watching.